All right, let's talk MFIC's second quarter earnings. On paper, the report looked a little all over the place. But the stock told a completely different story. We're going to break down exactly what the market saw and why it sent those shares climbing.
And, it didn't just nudge up, it jumped nearly 3.5% on the news. That is a pretty decisive reaction from the market, right? So what did investors see that the headline numbers maybe didn't show? Let's get into it and unpack the real story here.
Okay, so first things first, let's look at the numbers that hit the wire before the market even opened. This is what everyone saw first and what really set the tone for the day.
And right away, you see this classic beat and miss situation. On one hand, MFIC delivered a really clean beat on net investment income per share. And look, that's the core earnings metric everyone's watching for a company like this. But, on the other hand, they came in just a little light on revenue and saw their net asset value dip by, a small 1.2%.
But the size of that earnings beat, that's what's really key here. We're talking 39 cents a share. The street was looking for 37. So they cleared consensus by 2 cents, which is a solid 5% beat on the bottom line. And believe me, in this market, a beat like that gets noticed. It screams strong core earnings power.
But you and I both know, a stock doesn't move 3.5% just because of one number. No way. The real story, the reason for all this confidence, is buried a little deeper. It's all about the quality of their portfolio and the story management told on the earnings call.
So, about that small dip in net asset value, management got right out in front of it. They were super clear. They said, look, that pressure came from specific issues with just a handful of companies. The key takeaway here? These were isolated problems, not a sign that the whole portfolio was in trouble. And that, right there, was absolutely crucial for calming everyone's nerves.
And they've got the numbers to back up that story about quality. Check this out. A whopping 93% of their portfolio is in first-lien senior secured debt. Now, what does that actually mean? It means their portfolio is built to be defensive. It means that if one of their borrowers gets into trouble, MFIC is at the very front of the line to get paid back. That's a huge confidence booster for investors.
Okay, but here's where it gets really interesting. This is the real heart of the story. The market wasn't just giving them a pat on the back for a good quarter. No, it was looking ahead. It was pricing in a major catalyst, something clear, something you can put a number on, that's right around the corner.
And that catalyst is something called the Merx Aviation unwind. Basically, they're cashing out of an old investment. This isn't about a new loan they're making. This is about getting a big chunk of cash back, cash they can then turn around and put to work in new loans that earn them a better return. It's like finding money in the couch cushions, but, a lot more of it.
And how much are we talking? About $90 million. Let that sink in. $90 million, all coming back to them in the very next quarter. That is a ton of capital that's about to be freed up, ready to be put to work.
And here it is, the punchline. Management didn't just hint at this, they put a hard number on it. They said, straight up, that putting this $90 million back to work is going to add about 6 cents per share to their annual net investment income. See, that's not some vague promise for the future. That is a direct, measurable boost to earnings. And if there's one thing the market absolutely loves, it's that kind of certainty. But this Merx catalyst, as big as it is really just one piece of the puzzle. Management also gave us a pretty clear playbook for how they see the rest of the year playing out.
So their game plan has three main parts. First, they're betting on a recovery in M&A, which for them is the engine that drives new business. Second, obviously, is putting that Merx cash to work. And third, they're looking at repricing their own debt, basically refinancing to get a better rate for themselves. This is all about protecting their profit margins when things get competitive out there.
So let's just step back and look at the whole picture. You've got a clean beat on earnings, you've got a high-quality, super defensive portfolio, and on top of all that, you have a massive, clear-as-day catalyst for future growth that management has already put a number on. That is a really compelling story, right?
Which, of course, brings us to the big question for all of us. What's the trade? Has the market already priced all this good news in, or is there still more room for this thing to run?
Well, you can look at it two ways. The bull case is simple. That 6-cent boost from Merx is just the beginning. If the M&A market picks up like they hope, that's just fuel on the fire for future earnings beats. Now the bear case? It's that the M&A recovery stalls out, and competition gets so fierce that it eats away at their profits, basically canceling out the benefit from that Merx cash.
So where do we land? Our call here is outperform. We see their next quarter's net investment income coming in hot,
right around 45 cents a share. And the math on that is pretty straightforward. It's today's 39 cents plus that 6 cents they're getting from the Merx deal. Our take is that yes, the market liked the news, but we don't think it's fully priced in just how clear this path to a big earnings beat really is. And that's why we're setting our price target at $15.50.
And of course, just a final reminder for everyone, this analysis is for informational purposes. It is not financial advice.